Winter and a chilly profit season are wrapping up. While results on the whole haven't been spectacular, many have been better than expected. And analysts say there were plenty of hot stocks for the canny investor. Andrew Robertson reports.
The two-speed Australian economy is not running on all 8 cylinders, but those predicting doom and gloom in profit reporting season have on the whole been disappointed.
When you look at the overall numbers, the amount of business that was done was quite strong, especially in this sluggish environment, but people were paying a lot more. They're paying a lot more for staff, they're paying a lot more for input costs.
Which meant profits were squeezed. CommSec has studied 114 of the top 200 companies. They reported a total of $42 billion in profit, which was down 23% on last year. 16 of those 114 companies made a loss. Peter Warnes from research house Morningstar says most companies had put all their bad news into the market well ahead of reporting season.
Overall, the market, excluding those resource stocks that have taken a belting, is up, and so that the market's given the reporting season a tick.
Healthcare, telecommunications, IT and gaming-related stocks are among those to do well. With commodity prices led by iron ore continuing to tumble, miners had a tough time. Building-related stocks, discretionary retailers and wealth managers also disappointed. CommSec's Juliana Roadley says despite the tough climate, companies which were nimble and could innovate were rewarded.
If you look at the Flight Centre number, very strong. They've been able to see that people were able to have a little bit more discretionary cash. They weren't out there buying homes, but they were looking after themselves by going on small trips overseas, and they were able to package up exactly what Australians wanted to meet the challenge that was there.
Internet-related companies also fared well, with big players such as What If, REA and Car Sales all reporting around 20% earnings growth. And BBY analyst Mark McDonald says there were some pleasant surprises among smaller players.
For example, an IT services company like UXC had 7% revenue growth to $560 million, but 300% earnings growth.
The outlook for profits is one of the main reasons the stock market remains about 40% below its record high set in November 2007 in the lead-up to the global financial crisis. But according to Morningstar, investors who do their homework and pick the right companies in the right sectors can still make a lot of money. So, for example, companies like Ramsay Health Care and Telstra have 12-month total shareholder returns of more than 40%. Westpac and funeral company Invacare are in excess of 30%. ANZ, Wesfarmers and Commonwealth Bank all approaching 30%.
The defensive stroke income stocks, where you've got sustainable earnings and sustainable dividends, that has been a bull market of quite substantial proportions over the last 18 months.
But the bears were on the prowl for resources and building industry related stocks, and their profit results reflected that.